Good morning, traders. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me today for Trade Talks is Tony Zhang. He is with Options Play. Tony, thank you so much for joining us at Nasdaq. We want to hear more about the Options Play product and your top 5 income trades. So we have a lot for traders out there today. Give us a quick overview about Options Play.
So we started Options Play 4 years ago with the intentions of revolutionizing the way users experience options trading. And we wanted to change the user experience of how someone looked at analyzing and learning about options trading. And one of the biggest things that we learned in terms of deficit was the user experience based on the option chain. If you look at the option chain, it lists every single option that you can trade by strike price and expiration. And it's essentially a wall of numbers for a lot of beginners. It's almost like handing you a phone book and saying everything you need to know is in here, just go ahead and figure it out yourself. And we realized that for most beginners, that wasn't a great way to go about learning and exploring options trading. So what we did is we asked a simple question up front before you looked at the chain, and that's simply, what is your outlook on the underlying stock? Are you bullish on the stock? Are you bearish? Or maybe perhaps you're looking for income strategies. So by asking that simple question up front, what we're able to do is actually give you a very specific, tailored set of strategies that make sense for your specific outlook, as opposed to having to go out and search for what is the right strategy for you. Right. And by doing so, what we've been able to do is capture retail traders, financial advisors, all groups of users to be able to start exploring and discovering options by simply presenting options strategies to them that make sense for their given outlook.
It's a super clean platform. I use it myself. Let's talk about some trends, because you notice that registered investment advisors, the RIA world, is really picking up in terms of how they're incorporating option strategies into their portfolio management.
Yeah, so one of the most encouraging trends that we have is about 70% of the volume from the RIA space is actually just in covered calls alone. So we've actually made quite a bit of inroads in getting users who are traditionally just equity-only investors to start taking a look at options using covered calls specifically. We see some of it also in short puts as well, but those two strategies are by far some of the fastest growing trends that we're seeing, both on the retail and the financial advisory space. And by presenting options in this visual format to traders, what we've really seen is an adoption from a group of traders that traditionally weren't options traders to start adopting these types of strategies for their portfolio.
Right. Well, that's great for the clients, because everyone's always looking for more income, particularly in a low interest rate environment. But it's great for the options industry as well.
Exactly.
To see that kind of growth.
Exactly.
Right. So let's talk about some income trades, what type of investor it's suitable for, and the strategy behind it. Let's kick it off with covered calls, which typically is the most basic one to look at.
Right. So it's the most basic strategy, but also about 40% of the volume that we're seeing on our platform. So just that single strategy is the vast majority. And it's a simple strategy because it's allowing anyone who has an equity portfolio to add options to it to generate income without adding additional risk to their portfolio. It also lowers the volatility of their portfolio, which has additional benefits. One of the great things about covered calls is you have time decay working in your favor. So this is great for beginners who are just starting out in options. It allows them to generate some income on their existing portfolio without having to take a lot of risk from a delta perspective.
Right. Well, the risk to that, though, is you could be called away,
Correct.
Which is a good problem, because it means your stock has
Exactly.
clearly moved through the strike price to the upside.
Exactly. Your downside to the covered call strategy is you're limiting the upside above the strike price that you're selling on the covered call.
All right. And how about selling out of the money credit spreads?
So that's actually one of the interesting strategies, because traditionally this was more of an advanced strategy, but we're seeing a lot of beginners starting to take credit spreads in. And part of it is because there seems to be a preference towards taking a credit in as opposed to paying a debit up front, sometimes to the detriment of the trader, actually, specifically when we're talking about beginners, because sometimes the credit spread actually has worse risk-reward ratio than the debit spread. Sometimes you have higher assignment risk compared to the debit spread. So a lot of beginners may not understand all of those intricacies, but selling out of the money credit spreads has actually been, it's a strategy very similar to selling covered calls and short puts, but you don't have to own the underlying stock and you have limited risk. And the benefit really is because you can use it in different environments. You could have a relatively loose directional view and still trade out of the money credit spreads, and they can be used in high volatility environments, low volatility environments. So the fact that they can be used in a lot of different ways is kind of one
Right.
of the reasons why they're very popular.
And for the third one, we're going to look at short puts, which has been a very popular strategy, particularly in this market that's been in an 8-year bull run because it's been pretty easy to sell vol.
Absolutely. So short puts is one of my favorite strategies. And there's always been a stigma against selling naked puts because it comes with the stigma that there's a lot of risk in there. But once you wrap your head around that, this is a strategy not as a speculative strategy. This is really a strategy for someone who's looking to acquire the stock in the puts that they're selling. It becomes a much easier strategy to wrap your head around.
Well, it's a great stock replacement strategy. It's smart.
Exactly. That's actually where we're seeing a lot of RIAs adopting this strategy for their clients who are looking to acquire stock or dollar cost average into this stock. It allows them to generate some income while essentially putting in an order to buy that stock at potentially a lower price. Just like the cover call, it's a short theta trade, so you're able to capture some income while you put in your order.
All right, and let's move along to condors and butterflies because investors tend to shy away from multiple leg strategies. That's why I'm happy to hear that they're getting into credit spreads more often, but you're looking at a 4-legged strategy for these types of positions.
Yeah, so a condor and butterflies is a more advanced strategy, but it's really just a combination of both the out-of-the-money credit spread, call credit spread and out-of-the-money put credit spread. And it's a combination of those two married together. This is really a more advanced strategy because it requires a much deeper understanding of how all the Greeks affect option pricing as well as volatility. And it's generally a strategy that's really only useful in very specific volatility environments. Because you're trading 4 legs, it requires sometimes timing because most traders tend to either leg into these strategies or leg out of these strategies. And also, like you said, with the 3 to 4 legs, transaction cost and slippage is a much bigger factor when you're considering trading these strategies. So generally speaking, more for the advanced traders.
All right, let's wrap it up with straddles because we're starting to see people use that in terms of predicting earnings moves. That's a great way to use it, and anyone can look at straddles regardless if you trade options or not.
Yeah, so straddles is like you said, very useful in trying to predict earnings movements. However, it is a much more advanced strategy because of the fact that you are short 2 naked calls and puts. It has extremely large downside potential risk, has high margin requirements to trade the strategy. So it's not a strategy for most traders. However, for the professionals and for the very specific very sophisticated traders, it takes advantage of the fact that you're short both the calls and puts, which means you have time decay working for you on both sides. And it's only useful for very specific volatility expectations, meaning you expect volatility to come down. Usually after an earnings announcement, these types of strategies can be very profitable very quickly. But however, these are it requires timing to be very specific when you're trading these advanced strategies.
Okay, well, thank you very much. A ton of information for us today, Tony. We look forward to having you back at the Nasdaq Market Site, and thank you, as always, for joining me. We will have a blog post on our Market Insight site, wrapping up all of these strategies, including graphical content from Options Place, so it can help you visualize these strategies. From the Nasdaq Market Site in New York, I'm Jill Malandrino, Global Markets Reporter at Nasdaq.